Good evening, students. Now I am going to tell you the next chapter of macroeconomics, that is measurement of national income. Measurement of national income. In this chapter, we are going to study how to calculate, how to measure the national income of our country. So for that, we have three methods. First is income method. With the help of income, by calculating the national income, we are going to find national income by calculating the whole income of the country. Next, expenditure method. And third, that is value added method. So with these three methods, here we are going to learn how national income is to be calculated. The first method, that is income method. Income method. With the help of income method, how we are going to find national income? That is, if I am talking about national income, it can be denoted as NNP at FC. That is net national product at factor cost. Net national product at factor cost. That is clear? Now I am going to tell you how to find national income by income method. First of all, we are going to take compensation of employees. Compensation of employees. In that, suppose in the question, in the information, if compensation of employee is given, then we will take the value of compensation of employee. If its value is not given, so instead of it, under this two components are there, that is first wages and salary in cash or wages and salaries in kind. These are two things, in cash or in kind. And one more thing, employers' contribution to social security. So these are the two terms that is given when compensation of employees not given to you. Suppose if compensation of employees and these terms are also given in the information, so you have to take what? That is compensation of employees value only. You will not take these wages and salary in cash or kind or employers' contribution to social security. If compensation of employees value is not given, then you will take these two components which is to be given. Suppose one is given, so you will take one. You will not going to find the another one. कि दूसरा नहीं दिया है, the another is not given, so our answer is going to be wrong. No. What if in the information it is both the things are given, then we will take both the things. If both the things are not given, only one thing is given, so we will take one thing. That is clear? Next, and if compensation of employees value is also given and these two values are also given, these components of values is also given, so we will take compensation of employees value only. We will ignore these values. That is clear? Next, that is operating surplus. If operating surplus value is given, then we will take this value only. We can add these things. That is clear? Compensation of employee operating surplus. If operating surplus value is given, then it is okay. We will take directly this value. If it is not given, then what is to be given? That is profit, rent and royalty, might be it is to be given, separately, or maybe it will be given separately, or maybe together. That is clear. Interest. So if operating surplus value is not given, these values given, then we will take these values. That is clear. And suppose, again I am telling you, if operating surplus value is given and these values also given, then we will take operating surplus value. We are going to ignore these values. That is clear to everyone. Next, that one more thing in this. Suppose profit operating surplus value is not given, profit is given, rent, and profit value is not given. And instead of it, under this, three components, subcomponents are there. That is undistributed profit, dividend, and corporate tax. Corporate tax. Suppose profit is not given and these values given, then if all the three values given, then we will take 3. If 2, to only 2. If 1, to 1. We are not going to find the another things if it is not given in profit. But if profit is given and these values is also given, then we will take profit value, and rent and royalty, interest. That is clear. But if operating surplus value is given and these values are also given, then we will take only operating surplus value to calculate national income. Third component, that is mixed income. Mixed income of self-employed. These are considered as mixed income. Under this, no components are there, no subcomponents are there. So we will add this, then we will get, after adding this, what we will get, that is NDP. After adding these values, what we will get, NDP at FC, that is net domestic product at factor cost. This value is given, that is net domestic product at factor cost. But if I am talking about national income, the national income's formula is, that is NNP at FC, that is net national product at factor cost. So we need what? We need, that is NNP at FC. NNP at FC. NNP at FC, net national product at factor cost. But after calculating this, what we will get? Net domestic product. So for getting this NNP at FC, we need to move from domestic to national. And for that, what we should include in that, whatever the value will be coming after calculating these values, in that we are going to add one more thing, NAFIA. That is, that I have told you in the previous chapter, basic concept 1, that is net factor income from abroad. Net factor income from abroad. Suppose if net factor income from abroad is given, then we will add it in this value. Suppose net factor income to abroad is given, then we will subtract this value from NDP at FC. That is clear. And then we will get what? We will get NNP at FC. NNP at FC. That is clear to everyone. One more thing I am telling you. Suppose net factor income from abroad, that is given in negative value. So that's, you know it very well, plus minus minus. Yes, we should add it, but as you know the mathematical formulas, plus minus minus, and we will deduct it. Suppose this 2, it will be deducted from this NDP at FC, but it is given in negative value, then we will minus minus plus, then we will add it, and we will get NNP at FC. That is clear to everyone. Now I am going to tell you Now I am going to tell you next method, that is expenditure method. Expenditure method. How we will calculate national income with the help of expenditure method. First component, that is private final consumption expenditure. Add second, government final consumption expenditure. Third, that is gross oblique net domestic capital formation value. And fourth, that is net export. How we will calculate net export? Export minus import. Export minus import. X is denoted as export, M is denoted as import. So if net export value is not given, export and import is value given, then export minus import, you will get your net export. That is clear to everyone? Okay. Now I am going to tell how to find. First of all, we will take the value of private final consumption expenditure, government final. Under these, no components are there. Government final consumption expenditure. Then if gross or net domestic capital formation is given value, then we will add then net export. Now how we will calculate it? Suppose gross domestic capital formation is there. Gross domestic capital formation, we will add this. But if gross domestic capital formation is there, then what we will get by calculating it, we will get GDP at MP means gross domestic product at market price by calculating all the four components of expenditure method. That is clear? And suppose in the information net domestic capital formation is given, then what we will get with the help by calculating all these four components, we will get NDP at MP, that is net domestic price at market price. Net domestic product at market price. That is clear. And gross domestic capital formation is there. By calculating these four components, we will get GDP at MP, that is gross domestic product at market price. When net domestic capital formation is given, then we will get net domestic product at market price. That is clear. Now I am going to tell you that is, suppose in this information, anywhere if the fixed word is to be added in this information, suppose fixed, gross or net domestic capital formation is there, gross or net fixed domestic means fixed word is here. So one more thing is to be, there is a big change in that. What is the change? That is, we should add one more thing when this fixed word is added in this information. That is, we should add one more thing, that is change in stock. Change in stock, that is closing stock minus opening stock. That is clear. Closing stock minus opening stock. That's, you know it very well, to find change in stock. That is clear. This should be added when this fixed word is to be included in this information. That is domestic capital formation, either gross or net. If fixed is included in any of this information, Then we will include this change in stock also. We will add change in stock also with all these components, and we will get either GDP. If gross is given, then GDP at MP. Net is given, then NDP at MP. Now the question is arising in your mind. With the help of this, how we will find our national income? As you know, the national income formula, that is NNP at FC. Then how we will get? Because GDP at MP, NDP, okay, D we will get. Now I am going to tell you how we will get. If suppose with the help by the components of income method is given, and we will have to find GDP at MP, how we will get it, NDP and MP, how we will get it, and with the components of expenditure method is given, how we will find national income, NNP at FC, NDP at FC, how we will find. Then I am going to tell you. Suppose I am telling you that I have told you, that is D means domestic, N means national. From domestic to national, if we want to go domestic to national, we have to go with the NFIA, that is net factor income from abroad. Net factor income from abroad. So in this, if it is given net factor income from abroad, then we will add it from moving domestic to national. And if net factor income to abroad is, then we will deduct from moving to D to N, we will deduct this value from the domestic to get the national. That is clear? Okay. Now, obviously, if GDP is there, how will get national? Gross is given, net. How will get net? So for that, I am going to tell you. And if net is given, how will move to gross? G means gross, N is denoted as net. Here N net, J is gross. For that, for moving from gross to net, we will, that's gross from net. From gross to net, we will deduct depreciation. Depreciation, what we will do with depreciation? We will deduct it. From moving net to gross, we will add this depreciation. We will add this depreciation. That is clear? I will tell the depreciation formula also after this. Now, by expenditure method, we will get GDP at MP or NDP at MP. But the national income formula, that is net national product at factor cost, then from market price to factor cost, how will reach? So for that, one more is there, that is, if FC is given and if you required MP, then how will reach? If MP is given, how will reach to FC? That I am going to tell you. I will find FC. From factor cost to market price. For that, we have to go with the net. Net means net indirect tax. Net means net indirect tax. That I have told you in the other chapter. How will find indirect tax minus subsidies. Now, if factor cost is given and we require market price, then how will reach? I will find by adding this net, that is net indirect tax, we will include in the value to get the market price from factor cost. If market price is given, we need to get this factor cost, we will subtract it. That is clear to everyone? Okay. Indirect tax, that's know it very well. Now, only one tax is there in our country, that is GST. Subsidies, that is given by the government, means the essential goods which is provided to the people at a rate which is less than the market price. That is clear to everyone? Okay. Now, suppose in the information indirect tax is given and subsidy is not given. So we will consider subsidy as a 0. So whatever the indirect tax value is, that is net indirect tax. Suppose subsidy is given but indirect tax is not given. So we will take indirect tax, consider 0 and subsidy. So 0 minus the value, suppose 2. So 0 minus 2, we will get net indirect tax minus 2. Then if plus is there, then we will need to subtract it. Obviously plus minus minus. And when we need to subtract it, minus minus plus, so we will add it. That is clear to everyone? So these are the things to find national income. One more method is there, value added method, that we will discuss later. Yes, now the next method, that is value added method. Value added method. With the help of this method, the economists are able to find the GDP of the country. That's why it's to be donated at GDP at market price. It's not that GDP, it's value added method. That is clear? Gross value added at market price. Gross value added at market price. That is clear to everyone? Okay, for finding this, what components we require? That is first sales. If sales value is given, then that is okay. If it is not given, then might be in the information number of units sold and price per unit is given. So we will, what we will do, we will, whatever the number of units sold is given, we will multiply with price per unit, we will get our sales. In that, we are going to add, that is our change in stock. Change in stock, that's you know it very well. Closing stock minus opening stock to find change in stock. That is clear. Last, what we are going to deduct, in that we are going to deduct, that is intermediate cost. Intermediate costs are those costs which is to be incurred, like the purchase of raw material, payment paid to wages paid to that are to labor, power, fuels, expenses. These are to be considered as intermediate costs. So we will deduct it from by adding these two things. We will deduct this, but we will get our gross value added at market price. That is GDP at MP. That is clear to everyone? Clear? Now I am going to tell. Obviously, we need to take some precautions while calculating national income with the help of all these three methods. So I am going to tell one by one precautions while we are calculating our national income, our GDP and all. That's clear? Now first of all, the precautions of value added method. Value added method. The first precaution that purchase and sale of second hand goods are not included. Are not included. Why? Because when it's to be purchased first time or sale first time, its value is going to be, it has included at that time. So if we are going to include the second hand value, either we are going to purchase or sale, it will create a double counting, means 2 times is going to be count, and it will, the national income will not come right. So just because of that, purchase and sale of second hand goods are not included while calculating national income. Second intermediate goods are not included. The value of intermediate goods are not included. The reason behind it, as when we are calculating the we will take the value of final goods, or it will included the value of intermediate goods, the cost of intermediate goods also. Just because of that, intermediate goods value of intermediate goods are not included in the national income. Third, production of services for self-consumption are not included in national income while we are calculating national income. Why? Because, for example, the services like kitchen gardening, housewives services, these are not, because we are not able to calculate the data, we are not able to calculate in monetary terms. So because of that, we cannot include it in the national income. These services which are provided for self-consumptions are not included in the national income. Fourth, production of goods for self-consumption are included in the national income. Why? Because if the individual is producing goods for self-consumptions, it will include in the current output. As it increase the current output, so it will be included in the national income, because you are using intermediate goods, you have purchased raw material, you have purchased seeds, fertilizers and all. So that's the reason, because of that it is to be production of goods for self-consumption are included in national income. So these are the precautions of value added method. Now what precautions we will take while we are calculating national income by income method? So precautions of income method. First precaution, that transfer income are not included. Transfer income like donation, charity, old age pensions. Why these are not included? This transfer income is not included because against it we are not rendering any services, and it will not affect in the production of goods and services. So because of that, these are not included in national income. That is clear. Second, that is income from sale of second hand goods are not included. Why? Because once it is to be sale, first time when it has sold, at that time only it is included. So if we are going to include again, so it create a double counting problem. It will be counted, the value of the same particular goods will be counted or estimated in the national income 2 times. It will not give the right information about national income. That's because of that this income from sale of second hand goods are not included. Next, income from sale of shares, debenture, bonds are not included. Why it is not included? Because it will not affect the production of goods and services. With this income, you have invested and you have earned the income. It will not affect it will not increase, it will not give impact on the production of goods and services. It will not affect any production of goods and services. Just because of that, these financial assets income are not included in the national income. Next, that is windfall gain. Windfall gain means like if you are investing in lottery, spending in lottery and all, that type of gain are not included because it will not affect the production of goods and services, are not included. That is clear. So these are the precautions to calculate national income by income method. Now last, that is precautions of expenditure method. Precautions of expenditure method. What precaution we should take? While first is that is expenditure on intermediate goods are not included, because if we are going to include the expenses of intermediate goods, it will be double counted, because when we are going to go with the final goods we will take the value of final goods, so it will be these intermediate goods expenses are included in that final goods. So because of that, whatever the expenses we are bearing on intermediate good, these are not included while we are calculating national income. Next, that is transfer payment. Transfer payments are also not included. What payment we have done, like we are government is providing donation, charity to other country, so against it will not affect in the production of goods and services, and against it you are not asking for the same for the production of goods and services, for rendering their services. So just because of that, transfer payment are not included in national income. Third point, that is purchase of second hand goods are not included. Why it is not included? Because when it is to be purchased first time, when it is purchased first time, the value of that particular goods was estimated at that time only. If we are going to add or estimate or will take this value again, it will be create the problem of double counting, and the national income will not come in the right way. Again, next, purchase of financial assets. Financial assets are not included in the national income. Why? Because it will not affect the goods in the production of goods and services. So because of that, as financial assets, if we are going to purchase, obviously we get income on it, ठीक है ना? In return we are not rendering any services, we are not getting any goods. So for that, whatever the financial assets are to be purchased, and the firm or the government is bearing any expenses on it, these are not included in the national income. That is clear to everyone. Now I am going to tell you next topic, that is real GDP or nominal GDP. Real GDP or nominal GDP. GDP, you know it very well. The final value of goods and services which is to be produced by all the sector in the economy are to be considered as gross domestic product, are to be considered as GDP. So these are two types, real GDP and nominal GDP. Real GDP, first I am going to tell you nominal GDP. Nominal GDP are those GDP which is to be estimated, on the basis of current year price, When the value of goods and services is estimated on the basis of current year price, then it is to be considered as nominal GDP. The next, when the value of goods and services are estimated on the basis of base year price. While we are taking any base year, not current year price, then it is to be considered as real GDP. Now I am going to tell you when the value of goods and services is to be estimated on the basis of base year price, it is to be considered as real GDP. When it is to be estimated on the basis of current year price, it is to be considered as nominal GDP. That is clear. Now I am going to tell you which among these which is better, real or nominal is better. If I am telling real GDP is better because it help out to determine that what value will be increased in current year of goods and services. That is clear. Just because of that reason, real GDP is better. Suppose if we get to know how to find real GDP, suppose value is given, so how we'll find? First I am telling you nominal GDP. How will determine it? Nominal GDP, that is real GDP into price index upon 100. This is the formula for finding nominal GDP. Real GDP into price index upon 100, that is nominal GDP. Next, real GDP. That is nominal GDP upon real GDP, upon price index, into 100. What we will get are real GDP. That is clear to everyone. Here price index is nothing, it is considered as a GDP deflator. This nominal GDP, as you know, it will be affected by both change in the price and physical output. On the other hand, if I am talking about real GDP, it will affect by what? It will affect by change in physical output only, not by price. That is clear to everyone. Okay. Now I am telling you this price index. GDP. What is GDP deflator? The next topic, that is GDP deflator. It is for GDP deflator. It means it is the measure for determining the average value of goods and services to make up GDP. It is to be considered as GDP deflator. And what is the formula of it? That is nominal GDP upon real GDP into 100. What we will get? Our GDP deflator. That is clear to everyone. Now I'm going to tell you next topic, that is GDP deflator. Sorry, GDP and its welfare. GDP and welfare. Most of the time, what we are get to know, what we are considering, that index of welfare means GDP, it is to be considered as index of welfare of the people. Means as high the GDP, high the welfare of the country. Welfare means, here welfare means per person ability of goods and services in the country. Means as the goods and services are producing more, it means each and every person of the country are able to, means per person ability of goods and services is also high. But in a general term, this statement may not be correct because of the following reason. First reason, that is distribution of GDP. It is possible with rise in GDP, inequality of income is also rising. How? Inequality of income may also rise because it creates the gap between rich and poor. It increase the gap between rich and poor. As you know, those who are producing more, they will get more. Those who are producing less, they will get less income. So, if GDP is increasing just due to what? If GDP is rising, it creates this situation generally, because those who are producing more, they will get more income, they will produce more in future. So because of this reason, that GDP, it is considered as a welfare. No, it's wrong. It may not be correct, because those who are earning more, they are able to fulfill their needs in a very well manner as comparison to those who are getting less income. That is clear. Next, that is change in price. If GDP is increasing due to rise in price, not due to physical output, not due to increase in physical output, means the goods and services productions are not, it is not increased. The production of goods and services is not increased, but it will increase due to price. The GDP is increased due to price. So how it will be welfare for the people? It creates the situation of inflation, and people are facing lots of problem, and they are not able to get the means per person ability of goods are not to a large mass of population. Next, that is non-monetary exchange. Non-monetary exchange. Many activities in the economy, these activities are not evaluated or analyzed on the basis of monetary terms. For example, like kitchen gardening, services of housewives, these are not included, and they are not contributed in the GDP due to non-availability of data, because the data is not available for that, how much they are contributing in the production of goods and services, and due to that such activity are there which have the impact on the economic welfare, but these are not included, and these people are not getting that income. So per person ability of goods and services are not available just because of this reason. Fourth, externalities. What is externalities? Externalities, the activities, or you can say the benefit or harm due to individual or institutions activity for which they are not paid or penalized. Means if the individual are performing any activity which by which he get the benefit, and for that he is not paying anything, and suppose he is doing means which will harmful for the environment, for the surroundings, and for that he is not penalizing, that type of activities are to be considered as externalities. So activity which are providing benefit to others, these are considered as positive externalities. Activities which are considered as harmful to others, these are considered as negative externality. For example of positive externality, like we are using a public park, for that we are not paying anything, we are getting the entertainment, we are getting the facility, but for that we are not paying anything. Creating pollution, for that we are not penalizing. So because of that, it will not, means these external effect, they do not form any market transactions, they will not contribute in GDP, and due to that our GDP will not higher, means GDP is higher but welfare is not higher. That is clear. Last, that is rate of population growth. Rate of population growth. It means rate of population growth, GDP doesn't consider the change in the population growth. Suppose if the rate of population growth is higher than the growth in GDP, then per person ability of goods and services is going to be declined, which affect the economic welfare. And due to these reasons, we cannot say that higher the GDP, higher the welfare. This is the last topic, chapter have finished. That is clear. Thank you.